It was 12:30 in the afternoon, September 23rd, 1998. The fax machine in the corner of the office in Greenwich, Connecticut, let out a high-pitched whine. It was the sound of a lifeline arriving. Or maybe a death sentence. John Meriwether stood over it. He was a man known for his calm. He was icy cool. He was the man who could lose $50 million in a morning and go out for a burger at lunch without his pulse rising. But today, John Meriwether knew he was out of time. He was staring at a piece of paper that had just crawled out of the machine. He was the founder of Long-Term Capital Management, a fund that had been called the most impressive collection of intellect ever assembled in the history of finance, a fund that had, until very recently, been the envy of every banker in New York, London, and Tokyo. And now he was bankrupt. No, bankrupt is too small a word. Bankrupt happens to a dry cleaner or to a restaurant. Meriwether was purely existentially insolvent. He was a black hole in the center of the financial universe. His fund had borrowed so much money from so many different banks. Goldman Sachs, Merrill Lynch, Chase Manhattan, Deutsche Bank, that he was no longer just a hedge fund. He was a structural joint in the global economy. And that joint had snapped. If he went down, if he liquidated his positions, he wasn't just going to lose his partner's money. He was going to trigger a chain reaction that would detonate the balance sheets of every major bank on Wall Street. The piece of paper in his hand was his last chance to stop that detonation. It was an offer to buy the fund. It was from the only man on earth who had enough cash capital and enough guts to catch a falling knife this heavy, Warren Buffett. With him were two others, Goldman Sachs and the insurance giant AIG. The offer was simple. They would pay $250 million to buy the fund. They would inject $3.75 billion of fresh capital to stabilize the portfolio. They would take over everything. Meriwether and his partners would be out, but the fund would survive. The trades would be held. The global catastrophe would be averted. Meriwether looked at the clock on the wall. Buffett was known for many things. Patience was usually one of them, but not today. Buffett had given him less than an hour to sign the deal. There was no negotiation. There was no, let me call you back. It was binary. Sign the paper, fax it back, or the deal is dead. If the offer vanished, the next morning would likely be the end of the modern financial system as we knew it. Meriwether picked up the phone. He needed to call his lawyers and the Federal Reserve. He needed to tell his partners that their billion-dollar fortunes were now worth zero, but at least they wouldn't go to jail for destroying the world. But as he looked down at the fax, his heart stopped. The paper was blurry. It was barely legible. He squinted at the terms. He tried to read the fine print, but he couldn't. He needed to ask one simple question before he signed away his life's work. He dialed the number for Warren Buffett. But Warren Buffett was not in his office in Omaha. He wasn't in New York. Warren Buffett was on a private train somewhere in the wilds of Alaska. He was on a 12-day trip with Bill Gates. The clock was ticking. Imagine the situation. You are sitting on a nuclear bomb. The timer counts down. You have the code to stop it, but you can't read the code because of some snafu, and the only guy who knows the code is riding a train through the Alaskan wilderness, out of reach. It sounds like a bad movie script, but this is exactly what happened. The deadline passed and the deal was dead. And John Meriwether was left standing in his office, knowing that with the Buffett deal gone, there was only one option left. An option that would require 14 bankers, a room at the Federal Reserve, and a showdown that would change Wall Street forever. This is the story of how we got to that room. It is not a story about bad luck or stupidity. It is a story about the exact opposite. It is a story about genius. It is a story about a group of men who were so smart, so brilliant, so mathematically perfect that they convinced themselves they could predict the future. They bet $1 trillion that they were right. And the terrifying thing is, they were right. The math was perfect. The models worked. But they forgot one variable, the one variable that no equation can capture. They forgot that when people get scared, they stop acting like numbers. They start acting like animals. To understand the tragedy of long-term capital management, we cannot start in the 90s. We have to go back a decade earlier. We have to go to the jungle. The jungle was the 41st floor of One New York Plaza, the headquarters of Salomon Brothers. In the 1980s, Salomon Brothers was not just a bank, it was a cult. It was the most aggressive, most profitable, most feared firm on Wall Street. And the high priest of this cult was John Meriwether. He didn't look like a Wall Street killer. He wasn't loud. He wasn't brash. He was a quiet Midwesterner with an MBA from Chicago. He wore suspenders. He spoke softly with a distinct Midwestern mumble. He looked like the kind of guy who would help you change a flat tire in the rain. But inside that quiet shell was the mind of a gambler, a perfectly rational, cold-blooded gambler. Meriwether ran the arbitrage group. Inside the firm, they had a nickname. They were the masters of the universe, while the other traders were screaming into telephones, throwing headsets, and betting on gut instinct. Meriwether's corner was different. It was quiet. It was cerebral. Meriwether had a theory. He believed that the markets were filled with errors, tiny mathematical errors. He believed that most traders were stupid. They traded on emotion. They bought things because they liked them, and they sold things because they were scared. This emotion created noise. It created prices that were wrong. And Meriwether believed that if you were smart enough, you could find these wrong prices. He didn't hire the typical Wall Street loudmouths to help him. He hired PhDs from MIT and Harvard. He hired people who had never seen a trading floor in their lives, but who understood calculus. He taught them a game called convergence trading. Let's slow down and explain exactly what this is, because it is the engine of our entire story. Imagine you go to a car dealership. On the lot, there are two Ferraris. They are identical, exact same model, same year, and same engine. They came off the assembly line 1 minute apart, but one of them is painted red, and one of them is painted dark red. Now, most people don't care. They look the same. But for some reason, the red Ferrari is selling for $105,000. The dark red Ferrari is selling for $100,000. Any rational person knows this is stupid. The paint doesn't change the speed of the car. The fundamental value of the car is the same. Eventually, the market will realize this. Eventually, the hype will die down, and the prices will converge. Either the red one will drop to $100,000, or the dark red one will rise to $105,000. John Meriwether's team didn't look for cars. They looked for bonds. They would find a U.S. Treasury bond issued 29 years ago, and they would compare it to a U.S. Treasury bond issued 30 years ago. Technically, they were different. One had one more year of life. But mathematically, after doing all the adjustments for interest rates and duration, they should trade at a specific relationship. Meriwether's team would look at the screens and say, hey, the 29-year bond is trading for $99, but the 30-year bond is trading for $101. That spread is too wide. That is a mistake. So they would do the trade. They would buy the cheap one, and they would sell the expensive one. They didn't care if the whole bond market went up. They didn't care if the whole bond market went down. They were market neutral. All they needed was for the relationship between the two bonds to go back to normal. They just waited for the converging, and it worked. It worked beautifully. It was like vacuuming money off the floor. But there is always a catch. In the bond market, the discrepancy was tiny. It was pennies. It was fractions of pennies. If you buy $1 million of bonds and the price converges by 1 penny, you make a few $100. You can't run a Wall Street desk on a few $100. So Meriwether added the secret ingredient, leverage. He borrowed lots of money. If he had $1 of his own, he would borrow $99 from the bank. Now he had $100 to play with. If the trade made a 1% return, he didn't make 1% on his $1. He made 1% on the $100. He doubled his money. This was the magic info. Massive leverage times tiny volatility equals massive returns. For a decade, the arbitrage group was the golden goose of Salomon Brothers. They made hundreds of millions of dollars in profit. They were untouchable. But hubris always invites a fall. In 1991, disaster struck. It wasn't a bad trade. It was a scandal. One of Meriwether's top traders, a man named Paul Moser, a man Meriwether had hired, trained, and protected, decided that playing within the rules wasn't enough. Moser wanted to corner the market on U.S. Treasury bonds. He wanted to own so many of them that he could squeeze the other banks. But there was a rule. You couldn't buy more than 35% of a Treasury auction. So, Moser cheated. He realized that the computer system Salomon used simply checked the name on the order form. If he put in different names, he could buy more pieces. He started submitting fake bids. He submitted bids for his neighbors, his friends. He cornered the market. He broke the law, and he got caught. When the news broke, it wasn't just a fine. It was an existential threat. The U.S. government threatened to ban Salomon Brothers from trading government debt. That is a death penalty for a bank. Warren Buffett, who was a major investor in Salomon, swept in to save the firm. He flew to New York. He went before Congress. Ideally, he wanted to clean house. He fired the CEO, John Gutfreund. And then he looked at John Meriwether. Meriwether hadn't made the fake bids. Meriwether hadn't approved them. But Meriwether was the boss. And when Moser had first confessed the error to him months earlier, Meriwether hadn't immediately called the lawyers. He had hesitated. He had tried to handle it internally. That hesitation cost him his career. Buffett fired him. John Meriwether, the king of the game, was out. He was stripped of his title. He was fined $50,000 by the SEC. He was suspended from the industry. He went home to his estate in the suburbs. He sat in his garden. He watched the leaves fall. Most men would have retired. He was rich and famous. He could play golf for the rest of his life. But John Meriwether wasn't done. He was angry. He felt he had been wronged. He felt that his method, his philosophy, his genius had been interrupted by the stupidity of a rogue employee and the moralizing of Warren Buffett. He wanted redemption. He wanted to prove, not just to Wall Street, but to the world, that he was right. He conceived of a plan. He wouldn't just go back to work for another bank. He would build his own. He would build the greatest hedge fund history had ever seen. He would take his strategy and he would scale it up to a level that Salomon Brothers could only dream of. He picked up the phone. He started dialing. He wasn't hiring traders this time. He was hiring legends. Meriwether knew that to raise the billions, he needed more than just a track record. He needed a halo. He needed to convince conservative pension funds, foreign governments, and university endowments to give him their cash. These are people who are terrified of risk. So he decided to hire men who represented the opposite of risk. He hired the men who had invented the math of risk management. First, he called Robert Merton. Merton was a professor at Harvard. He was arguably the most brilliant financial theorist alive. He had expanded the understanding of how to value confusing assets like stock options. Then, he called Myron Scholes. Scholes was from Stanford. He was the co-creator of the Black-Scholes model. If you don't know finance, it is hard to explain how famous the Black-Scholes model is. It is the E equals MC square of Wall Street. Before Black-Scholes, pricing an option, a bet on a future price, was a guessing game. After Black-Scholes, it was a formula. You punched in, the numbers and the truth came out. These two men were about to win the Nobel Prize in economics. They were the gods of the discipline. It was a coup. It was like a startup basketball team hiring Michael Jordan and LeBron James as assistant coaches. But Meriwether didn't stop there. He wanted political cover. He hired David Mullins. David Mullins wasn't just an economist. He was the vice chairman of the Federal Reserve. Think about the implications of this. Meriwether hired the guy who was responsible for regulating the huge banks that Meriwether planned to borrow from. It was a masterstroke. When David Mullins walked into a meeting with a bank, the bankers sat up straight. They didn't see a hedge fund manager. They saw the ghostly image of the Federal Reserve itself. It signaled, this fund is safe. This fund is sanctioned. This fund is part of the system. With this dream team assembled, Meriwether launched his roadshow in 1993. The pitch meetings were legendary. Usually, when a hedge fund tries to raise money, they beg. They bring presentations. They promise transparency. They offer low fees. LTCM did the opposite. They walked into the conference rooms of Merrill Lynch and UBS with an air of absolute superiority. The minimum investment is $10 million. You cannot take your money out for 3 years. Most funds allowed withdrawals every year. We will charge fees of 2% of assets and 25% of profits. The standard was 1 and 20. And the kicker? We will not tell you what we are doing. They called it a black box. They argued that their trades were so complex, so brilliant, so sensitive, that if they explained them to the investors wouldn't understand them. Worse, would leak them to competitors. The pitch was simple. Trust us. Look at the names on the door. Look at the Nobel Prizes. We have solved the market. The investors loved it. The arrogance was the selling point. It made them feel like they were being invited into a secret club. If these guys were this confident, they must be right. Money poured in. Merrill Lynch didn't just invest. They sold the fund to their own wealthy clients. They raised hundreds of millions. Banks lined up to lend to them. By the time they launched in early 1994, long-term capital management had over $1 billion in equity. They set up their headquarters in Greenwich, Connecticut. It wasn't a flashy Wall Street tower. It was a modernist glass building overlooking the Long Island Sound. It was quiet, serene. There was no screaming, no running, just rows of computers humming, and the professors walking around in their cardigans, scribbling Greek letters on whiteboards, debating the curvature of yield spreads. It felt like a university. It felt like a laboratory where clean, sterile science was being conducted. But it wasn't a lab. It was a casino. And they were about to place the biggest bets in history. For the first 3 years, the Dream Team looked like they walked on water. In 1994, while the rest of the bond market was getting crushed by interest rate hikes, LTCM returned 21%. In 1995, they returned 43%. In 1996, 41%. These numbers were staggering, and they were doing it with seemingly zero volatility. The line on the chart just went up, holding a ruler to it. How? They were using the vacuum cleaner. They had built computer models that scanned every market in the world: Tokyo, London, Frankfurt, New York, looking for those dusty Ferraris. Let's look at one specific trade to understand the mechanics called the Italian swap. In the mid-90s, Europe was preparing for the euro. They were going to merge all their currencies into one. This meant that eventually, the interest rate of Italy and the interest rate of Germany would have to be exactly the same. You can't have one. Currency with two interest rates, but the market didn't fully believe it. The market was scared. Traders thought, Italy is chaotic, Germany is disciplined. What if the euro falls apart? So Italian government bonds were trading at a discount. They had a higher yield than German bonds. LTCM's models looked at this and said, the probability of the euro failing is statistically near zero. The political will is too strong. So they put on the trade. They bought the Italian bonds. They sold the German bonds. They bet that the spread, the difference in price, would close. If they were right, they would make a small profit, maybe 20 basis points. That's 0.2%. Who gets out of bed for 0.2%? John Meriwether does, because he has a secret weapon, the repo market. The repo market is the plumbing of Wall Street. It's a pawn shop for banks. Here is how it works. LTCM buys $100 million of Italian bonds. They take those bonds to a bank, say, Bear Stearns. They say, I want to borrow cash. You can hold these bonds as collateral. Bear Stearns says, okay, these are safe government bonds. We will lend you $99 million cash against them. LTCM takes the $99 million, and what do? They go buy more Italian bonds. Then they take those bonds back to the bank. Hey, look, more collateral. Lend me more cash. They rinse and repeat. Normally, a bank demands a haircut. They say, we will only lend you 90% of the value. This limits how many times you can loop the trade. But LTCM was special. They were the masters of the universe. They were the vice chairman of the Fed fund, so the banks competed to lend to them. We'll give you a zero haircut, one bank would say. We'll lend you 100% of the value. This allowed LTCM to achieve infinite leverage. They could turn $1 million of equity into $100 million of positions. So that tiny 0.2% profit, when you multiply it by 100 times leverage, it becomes a 20% profit. It was magic. They did this everywhere. They did it with Danish mortgages and Danish bonds. They did it with U.S. Treasury bonds. They were picking up nickels in front of a steamroller, but they were picking up billions of nickels, and they were convinced the steamroller was parked. By 1997, the fund had grown into a monster. They had about $4 billion of their own money, but they had borrowed over $120 billion from banks. That is a leverage ratio of 30 to 1. But wait, it gets worse. They also entered into Derivative contracts. These are bets that don't show up on the balance sheet same way. The notional value of their derivative book, the total amount of money that their bets controlled, was $1.25 trillion. To put that in perspective, that was roughly the size of the entire annual budget of the United States government, held by one firm. In Greenwich, Connecticut, run by fewer than 200 employees, they had become so big that they were the market. They weren't just betting on prices. Their buying and selling was setting the prices. And when you are that big, you have a problem. You can't get out. If you try to sell $1 trillion of anything, you crash the price of the thing you were selling. They were trapped in their own success. They had built a position that was impossible to unwind. And that is usually the moment when the universe decides to test your math. 1997 started as a victory lap. In the fall, the call came from Stockholm. Myron Scholes and Robert Merton had won the Nobel Prize. It was the ultimate vindication. The press loved it. The professors who beat the market. It cemented the idea that LTCM wasn't gambling, it was science. But inside the glass walls of the Greenwich headquarters, the mood was shifting. They were making too much money, or rather, they had too much money to make. The vacuum cleaner had worked too well. They had sucked up all the loose change in the global markets. Copycat funds had sprung up. They were mimicking LTCM's trades, making the spreads thinner and thinner. The opportunities were vanishing. Meriwether faced a strategic crisis. If he kept all the investors' capital, their returns would drop. You can't earn 40% on $7 billion if there are no trades to do. Returns would drop to 10%. Or 6%. That would be embarrassing. The dream team couldn't be average. They had to be exceptional. So Meriwether made a fateful decision, a decision that many of his partners argued against. He decided to return capital. At the end of 1997, he sent checks back to his investors. He returned $2.7 billion. His message to investors was clear. They had too much cash sitting idle. Take it back. But, and this is the critical error, he didn't sell the positions. He kept the $120 billion of bets. He just reduced the safety cushion underneath them. Think about a skyscraper. He didn't make the building shorter. He just dug out half the foundation. The leverage ratio skyrocketed. It went from 18-1 to 28-1 almost overnight. They were now incredibly fragile. A small drop in the market, a tiny 2 or 3% move, could wipe out all their remaining equity. But they weren't worried. Their models told them that a loss that size was statistically impossible. It was a 5 sigma event. It would only happen once every million years, and besides, they needed to find new ways to make money. Since the safe bond trades were crowded, they started looking elsewhere. They drifted into things they didn't understand as well. They started betting on M&A, merger arbitrage. They started betting on the volatility of the stock market. They sold options. They sold insurance against market crashes. Their logic was, markets are volatile right now, but they will calm down. We will collect the insurance premiums. It was a classic short volatility trade. It works every day, returning small, steady profits. Until the day the market crashes and you lose everything. They were essentially betting that nothing crazy would ever happen again. The world has a sense of irony. Just as LTCM bet that the world would be calm, the world set itself on fire. It started in Thailand. July 1997, the Thai baht collapsed. It triggered a domino effect. The Asian Contagion, economists called it. Investment capital, which had poured into the Asian tigers for a decade, suddenly panicked. Money fled Thailand. Money fled Indonesia. Money fled South Korea. Banks failed. Governments wobbled. For most investors, this was terrifying. But for LTCM, it looked like a buffet. Remember their core philosophy. Panic creates mispricing. They looked at the chaos and said, "This is irrational. These markets will bounce back. The spreads have blown out too wide. We should sell volatility." They doubled down, used the Ferrari analogy again. The dusty Ferrari was now selling for $50,000 because everyone was afraid of cars. The shiny Ferrari was selling for $150,000 because everyone wanted safety. LTCM bet everything that the gap would close. But the gap didn't close. The fear didn't go away. As 1998 began, the crisis mutated. It wasn't just Asia anymore. The fear was spreading to other emerging markets, Brazil, Latin America, and the biggest, scariest emerging market of them all, Russia. Russia was the Wild West. It was a nuclear power, but its economy was held together by duct tape and oil sales. The price of oil was dropping because of the Asian crisis. Russia was running out of money, but Russian government bonds were paying insane interest rates, 40%, 50%. LTCM's models looked at those yields and salivated. The model asked a simple binary question. Will Russia default on its domestic debt? History said no. Sovereign nations don't default on their own currency. They just print more rubles to pay the debt. It causes inflation, sure, but it's not a default. So LTCM bought Russian bonds. Lots of them. They thought they were hedged. They bought insurance against the ruble falling. They thought they had covered their bases. They were playing chess. But Russia wasn't playing chess. Russia was playing Russian roulette. August 17th, 1998. A Monday morning. John Meriwether arrived at his desk in Greenwich. The screens were already flashing red. News had come out of Moscow over the weekend. The Russian government had announced a restructuring. It was a polite word for a catastrophe. Russia was devaluing the ruble, and, the unthinkable part, they were defaulting on their domestic debt. They were simply not going to pay. And the hedge? The insurance contracts LTCM had bought from Russian banks to protect themselves? Worthless. The Russian banks themselves were insolvent. The counterparties didn't exist anymore. It was a Black Swan, an event that the models said was impossible. But the real problem for LTCM wasn't the money they lost in Russia. They lost maybe hundreds of millions there, painful but survivable. The real problem was the reaction of the rest of the world. Investors in London, New York, and Tokyo saw Russia collapse and thought, if a superpower can default, anything can happen. They panicked. Pure, unadulterated terror. They sold everything that had even a whiff of risk. Corporate bonds, mortgages, emerging market stocks. And they took all that cash and put it into the only safe place left on Earth. The U.S. 30-year, on-the-run Treasury bond. This was the nightmare scenario for LTCM. Remember their biggest trade? They were short the on-the-run bond and long the off-the-run bond. They needed the spread to close. But because everyone in the world was buying the on-the-run bond, its price skyrocketed. And because everyone was selling the slightly less liquid off-the-run bond, its price plummeted. The spread didn't converge. It exploded. It went from 6 ticks to 12 ticks to 20 ticks. It was a 10 sigma event, a statistical impossibility. But it was happening. Every single trade in LTCM's portfolio, the Danish mortgages, the swap spreads, the volatility bets, they were all correlated. The models assumed these markets were different. Danish mortgages have nothing to do with Russian bonds. But in a panic, everything is correlated. In a fire, everyone runs for the same door. On that single Monday, LTCM lost $550 million. 15% of their equity vaporized in day. Meriwether called a meeting. The partners were stunned. The professors were looking at their shoes. The math wasn't working. Meriwether tried to project confidence. The fund was still solvent, he insisted. The market was wrong. They just needed to ride this out. The trades would converge. But the market manages to stay irrational longer than you can remain solvent. The weeks that followed were a slow-motion execution. September arrived. The bleeding didn't stop. On Thursday, September 3rd, Meriwether finally wrote a letter to his investors informing them that the fund has lost 52% of its value. The revelation sent a shockwave through the industry. Everyone knew LTCM was down. Nobody knew they were dead. And now, the sharks smelled blood. The big banks, the same banks that had lent LTCM money, started to turn on them. They issued margin calls. A margin call is a demand for cash. Your collateral has dropped in value. Send us $500 million by 5 p.m., or we sell your bonds. LTCM was scrambling for cash. They were selling whatever they could. But the other hedge funds figured out what was happening. They knew LTCM had to sell. So they engaged in predatory trading. If they knew LTCM had to sell swap spreads, the competitors would sell them first, driving the price down, forcing LTCM to sell at a worse loss, which drove the price down further. It was a death spiral. Meriwether spent his days on planes. He flew to Europe. He met with UBS. He met with George Soros. He begged for capital. His pitch was simple. The opportunity was incredible. The spreads were at historic highs. Anyone who invested now would make a fortune. It was a rational argument. But nobody wanted to step in front of the freight train. Soros passed. The banks passed. By the third week of September, the equity was almost gone. They had started the year with nearly $5 billion. They were down to under $600 million. But the debt load was still exactly the same, $100 billion. The leverage ratio was now astronomical. Over 100 to 1. They were days away from zero. And the Federal Reserve began to look at the data. They realized that LTCM wasn't just a fund, it was the counterparty to everyone. The Federal Reserve realized the danger. If LTCM defaulted on $1 trillion of derivatives, the entire payment system of Wall Street could freeze. This brings us back to the fax machine. Wednesday, September the 23rd. The Buffett bid had just failed. The clock had run out. The AIG Goldman Buffett rescue was dead. The call came from New York. The morning of September 23rd. The meeting was held in the Federal Reserve Bank of New York, a fortress of Italian sandstone in Lower Manhattan. William McDonough, the president of the NY Fed, presided. He sat at the head of a massive mahogany table. Around him sat the CEOs of the 14 biggest banks in the world: Sandy Weill of Citigroup, David Komansky of Merrill Lynch, John Corzine of Goldman Sachs, Douglas Warner of JP Morgan. These men were titans. They were rivals. They spent every waking hour trying to destroy each other, and now they were locked in a room and told to work together. McDonough told them the reality. If LTCM fails tomorrow, the system breaks. You all take losses you can't afford. He told them they had to solve it, not the government. The Fed wasn't putting up tax dollars. The banks had to put up their own money to bail out their competitor. This is a crucial point often misunderstood. The Fed didn't pay. The Fed held the gun. He demanded that the banks form a consortium. They would collectively put up $3.6 billion to buy 90% of LTCM. They would inject the cash. They would take control. They would slowly unwind the trades over months, preventing a crash. They argued they didn't want to do it, but slowly they realized they had no choice. They went around the table, pledging $300 million each, until they got to Bear Stearns. Bear Stearns was represented by its CEO, Jimmy Cain, and they had a grudge. Cain was still bitter about how Salomon Brothers had treated Bear Stearns years ago. According to Roger Lowenstein's account of the meeting, when the Fed officials suggested an equal split, Cain reportedly refused. "We're not going to put up any money," Cain effectively said. He argued that as LTCM's clearing agent, Bear Stearns was already protected by collateral. They didn't need to join the bailout. Cain is famously quoted as saying, "Don't go alphabetically if you want this thing to work." The room was furious, but they couldn't force him. The other banks agreed to cover the shortfall. They put up $3.6 billion. They took 90% of the fund. Meriwether signed the deal. The Buffett bid, the 1-hour deadline, had failed. But this deal, the consortium deal, succeeded. He signed away his company. He signed away his ownership. Long-term capital management was no longer his. It belonged to the banks. The disaster was averted. The markets opened the next day. The world didn't end. But the era of the genius was over. The cleanup took 2 years. The consortium of banks, now owners of the fund, slowly sold off the positions. And here is the final bitter irony. They made a profit. The models were right. Once the panic subsided, the spreads converged. The Italian bonds and German bonds moved together. The dusty Ferrari and the shiny Ferrari became the same price. The banks got their $3.6 billion back, plus a nice profit. If Meriwether had just had enough money to hold on for a few more months, if the leverage hadn't been so high, he would have been right. But in finance, being right too early is the same as being wrong. What happened to the men? John Meriwether was ruined, reputation-wise. But he didn't quit. A year later, he started a new fund, JWM Partners. He used the same strategy. He raised billions. He had a good run. Until 2008. In the great financial crisis, his new fund blew up again. Same strategy, same leverage, same impossible market crash. Fool me once, shame on you. Fool me twice. Myron Scholes and Robert Merton went back to academia. They still hold their Nobel Prizes. Their formulas are still taught in every business school in the world. But they stopped talking about solving the market. David Mullins, the man from the Fed, faded into obscurity. The regulator who joined the gamblers became a cautionary tale for government ethics. And Bear Stearns, the bank that refused to chip in the $300 million. 10 years later, in March 2008, Bear Stearns was the first bank to collapse in the subprime mortgage crisis. They failed because they had too much leverage. They failed because they held toxic assets they couldn't sell. And when they went to the Fed, begging for a bailout, begging for the other banks to save them, nobody came. Karma, in the end, is the only convergence trade that pays out 100%. So, what is the lesson of long-term capital management? It isn't that math is bad. We need math. We need models to price our world. The lesson is about humility. They looked at their models and thought they were looking at the world, but they were just looking at a simplification of the world. They forgot that at the end of every trade, there is a human being who can panic, a human being who can be irrational. You can calculate the odds of a coin flip. You can calculate the stress load of a bridge, but you cannot calculate the breaking point of the human soul. And when fear takes the wheel, the smartest guys in the room are just passengers, screaming just like the rest of us.